Hello, I'm John A.G., and I want you to think about a moment when something still looks normal but no longer feels normal. The prices are there, the markets are open, the systems are running, and yet a quiet assumption you've relied on for years has already stopped being true. Nothing has officially broken. No alarms are sounding. But if you know where to look, you can feel the tension building under the surface. That's where we are right now. It's Monday, January 26th, 2026, and before this week unfolds, there's a structural issue in the silver market that most people are completely missing, not because it's hidden, but because it doesn't show up where people are trained to look. This isn't about price targets, charts, or momentum. It's about whether the system that prices silver can still function when tested by reality. Silver trading around the low teens isn't the story. Even the looming government shutdown at the end of this week isn't the core issue. The real stress is building inside the delivery system itself. And once you understand that, you start to see why this week matters in a way that has nothing to do with headlines. Over the weekend, I went through the latest settlement data, lease rates, and inventory reports. On the surface, the market looks calm. Silver closed last week just under $14 after a sharp move higher. Gold is sitting just below the psychologically important $5,000 level. Platinum, which rarely attracts attention outside industrial circles, is quietly signaling distress with lease rates near 16%. To most observers, these are just numbers. To anyone watching structure, they are warnings. Let's start with something simple. The screen says silver is available at a posted price. The physical market says otherwise. As of this weekend, major retail dealers show 100-ounce silver bars completely unavailable, with no delivery estimates. 1,000-ounce bars, the same size used in institutional settlement, are effectively non-existent for near-term delivery. This is not a shipping issue. It's not a temporary backlog. It's a supply gap. When a market moves from pricing availability to questioning existence, the rules change. Price stops being the primary signal. Availability takes over, and availability is the one variable paper markets are least equipped to handle. This is where people make the mistake of assuming retail shortages don't matter. Retail doesn't drive the market, but it does expose stress early. Retail is where inventory pressure shows up first, because there's no ability to disguise it with contracts or offsets. When dealers can't source metal at any price, it means upstream supply is already tight. Retail doesn't cause the shortage, it reveals it. Now, layer that onto what's happening institutionally. The futures exchange is heading into a major delivery window with elevated open interest. Tens of millions of ounces of silver are standing for delivery. In normal conditions, that wouldn't be alarming. Most contracts settle in cash or roll forward. Physical delivery is treated as theoretical. The vaults only need enough metal to satisfy a small percentage of demand. That assumption is now being challenged. We know this because lease rates are exploding. A lease rate is the cost to borrow physical metal, not money. Under normal conditions, silver lease rates hover near zero. That's because metal is plentiful, and lenders are comfortable leasing it out. When lease rates spike, it's not because traders are speculating. It's because entities with delivery obligations cannot source metal through normal channels and are willing to pay almost anything to borrow it temporarily. Silver lease rates have jumped more than 10 times their historical norm. Platinum lease rates are even worse. That doesn't happen in a speculative frenzy. It happens in a supply squeeze. Think of lease rates as a stress test for the physical market. They measure desperation, not enthusiasm. When lease rates rise, it means lenders have stopped lending, not because they want higher returns, but because they don't trust that metal will be returned. At the same time, borrowers are bidding aggressively because failure to deliver isn't an option they can accept. This is the part of the system most people never see. Futures markets are built on trust. Trust that contracts can be settled. Trust that delivery is possible if demanded. Trust that oversight exists to manage stress. When that trust erodes, the market doesn't collapse instantly. It starts behaving differently. Participants shorten time horizons. They stop assuming cooperation. They prioritize certainty over efficiency. And that behavior feeds on itself. This brings us to the government shutdown. On Friday, the Senate failed to pass a continuing resolution. If nothing changes, parts of the federal government go dark at the end of the week. Most coverage treats this as political theater, but for markets under stress, it has a very different meaning. A shutdown removes real-time oversight. Commodity regulators pause reporting. Inventory updates stop. Enforcement slows. Transparency disappears. Officially, everything continues as normal. Practically, the referee leaves the field. That matters when delivery obligations are peaking. In a fully functioning regulatory environment, stress triggers coordination. Agencies communicate. Emergency measures are discussed. Information flows freely enough for participants to assess risk. During a shutdown, that structure vanishes. And everyone knows it. When visibility disappears, uncertainty increases. And uncertainty does not calm markets. It accelerates defensive behavior. If you are short physical silver and you believe others may rush to cover before oversight disappears, you don't wait. You act early, even at unfavorable prices. You pay up for certainty. That behavior tightens supply further, pushing lease rates higher and availability lower. This is how stress compounds without ever making the news. There's a widespread belief that data blackouts somehow suppress volatility, that no news is good news. That belief is backward. Transparency dampens volatility. Opacity amplifies it. When participants can't see what others are doing, they assume the worst. They act preemptively. Liquidity doesn't fade gradually. It vanishes. This is why comparisons to March 2020 are misleading. That crisis was about liquidity. Banks needed dollars. Assets existed, but they couldn't be sold fast enough. The solution was massive cash injection. Today's problem isn't cash. Liquidity is abundant. Central banks are explicit about that. The problem is inventory. You can print dollars. You cannot print silver bars. If a delivery obligation comes due and the counterparty insists on physical, cash settlement becomes a failure mode, not a solution. It preserves the appearance of order while quietly transferring value. Over time, that changes how participants view the entire market. And that's the risk most people are missing. This isn't about silver going up or down this week. It's about whether the promise embedded in paper pricing can still be honored when challenged by physical demand. If it can't, behavior changes permanently. As we move closer to the end of the week, the market is approaching a moment of truth. Not a dramatic one, not a crash, but a test. A test of whether abstraction still holds when reality presses back. In the next part, we'll walk through how institutions respond when they realize the system may not protect them, why rule changes and margin hikes don't solve physical shortages, and how confidence erodes long before anyone admits there's a problem. Because once delivery stops being theoretical, everything else becomes secondary. When markets reach this stage, the most important shifts happen quietly, long before anyone uses the word crisis. Institutions don't wait for confirmation that something is broken. They act on probability, incentives, and risk asymmetry. And right now, the incentive structure inside the silver market is changing in ways that are easy to miss if you're only watching price. The first thing that changes is behavior around delivery. For decades, futures markets have relied on an unspoken understanding. Physical delivery exists, but it's rarely exercised at scale. Most participants treat contracts as financial instruments, not acquisition tools. That assumption allowed paper supply to expand far beyond physical availability without consequence. As long as most contracts settled in cash, the system worked. What lease rates are telling us is that this assumption is failing. When physical borrowing costs rise sharply, it means the metal needed to satisfy delivery requests is no longer easily accessible. Lenders are pulling back, not because they want better terms, but because they're no longer confident in the return of their inventory. Borrowers, on the other hand, are becoming less sensitive to cost because the alternative is default. This is the moment when a market stops being governed by optimization and starts being governed by obligation. Obligation is rigid. It doesn't care about sentiment or positioning. If you owe metal, you owe metal. And if the system can't provide it smoothly, stress migrates from prices into structure. One common response to structural stress is margin adjustment. Exchanges raise margin requirements to reduce leverage and cool speculation. This tool is effective when excess leverage is the primary problem. But leverage isn't the core issue here. Scarcity is. Raising margins can force weaker participants out, but it doesn't create new supply. In fact, it can intensify pressure by concentrating positions among participants most capable of demanding delivery. Another tool is liquidation-only trading, where new positions are restricted and only existing positions can be closed. This is designed to stabilize markets during extreme volatility. But again, it addresses price dynamics, not physical constraints. If the problem is that promised metal doesn't exist in deliverable form, limiting trading activity doesn't resolve that mismatch. It merely delays its recognition. Then there's cash settlement. On paper, this is the ultimate safety valve. If physical delivery becomes impractical, contracts are settled financially. The exchange remains solvent. Participants receive compensation. Order is maintained. But this mechanism comes with a hidden cost. It breaks the link between contract value and real-world value. If physical silver is trading at a significant premium to futures prices, cash settlement compensates based on an abstraction, not reality. The party expecting metal receives dollars instead, often at a price that reflects paper liquidity rather than physical scarcity. Over time, this erodes confidence in futures as a tool for exposure to actual metal. They become instruments of convenience, not trust. This erosion doesn't show up immediately. It shows up in behavior. Participants who truly need metal stop using public exchanges. They seek bilateral agreements, private storage, direct sourcing. Liquidity migrates away from visible venues into opaque ones. The market fragments. Gold's proximity to $5,000 accelerates this process. At that level, gold ceases to function purely as a commodity. It begins to function as a monetary reference point. Central banks and sovereign institutions don't treat assets at that scale lightly. They become more cautious about lending, selling, or leasing. Every ounce takes on strategic weight. Silver, because of its smaller size and dual industrial monetary role, experiences this shift more violently. Industrial users can't simply switch inputs. Investors can't easily source supply. When both sides encounter constraints simultaneously, the market's elasticity disappears. Price becomes a blunt instrument, incapable of clearing demand smoothly. This is where psychology matters. Markets rely on shared expectations. When participants believe others will act rationally and predictably, cooperation emerges naturally. When that belief weakens, behavior changes preemptively. No one wants to be last. No one wants to rely on assurances that may not be enforceable. The impending government shutdown exacerbates this dynamic by removing shared visibility. Without regular reporting, participants lose common reference points. They no longer know inventory levels, open interest changes, or enforcement posture. In that environment, decision-making becomes defensive. Worst-case scenarios dominate because the cost of being wrong is asymmetric. It's important to understand that this doesn't require panic. It requires caution. Institutions don't panic. They hedge, they cover, they withdraw. And those actions taken individually and rationally collectively tighten conditions. There's also a misconception that if something were truly wrong, price would already reflect it. That belief assumes markets always transmit information efficiently. They don't, especially when information is incomplete or delayed. Structural stress often shows up first in non-price signals: lease rates, premiums, delays, unwillingness to quote. These are the early warnings. By the time price fully reflects a structural issue, the adjustment is already well underway, and once it happens, it tends to overshoot, not because fundamentals changed overnight, but because confidence did. Another layer of complexity comes from the derivatives ecosystem surrounding silver. Futures don't exist in isolation. They're embedded in a network of options, swaps, and structured products. Stress in one area propagates through margin requirements and collateral relationships. If silver becomes volatile or difficult to source, it can trigger margin calls elsewhere, forcing asset sales unrelated to silver itself. This is how localized stress becomes systemic, not through headlines, but through plumbing. When collateral values fluctuate and obligations are questioned, risk managers respond by reducing exposure broadly. That response can pull gold, currencies, and even equities into the orbit of a silver-specific issue. This doesn't mean collapse is inevitable. It means pathways narrow. The range of benign outcomes shrinks as constraints accumulate. Each unresolved stress reduces flexibility. At this stage, the market's fate hinges less on macro narratives and more on execution. Can deliveries be met? Can obligations be rolled without coercion? Can confidence be maintained without transparency? These questions don't have theoretical answers. They have operational ones. As the week progresses, watch not just what moves, but what stalls. Watch which quotes disappear. Watch which dealers stop committing to timelines. Watch which instruments trade by appointment rather than continuously. These are signs of a market transitioning from abundance to rationing. In the next part, we'll look at how this transition typically resolves, why markets often appear calm just before structural breaks, and what signals matter most when traditional indicators lose relevance. Because when availability replaces price as the primary constraint, the rules everyone learned stop applying. By the time markets reach this phase, the outcome is rarely decided by emotion or surprise. It's decided by logistics, incentives, and timing. Systems don't fail because everyone suddenly realizes the truth at once. They fail because a small number of participants quietly conclude that the assumptions they were relying on no longer protect them, and they act accordingly. What follows isn't chaos, it's withdrawal. This is the point where price becomes a misleading guide. Markets don't always break by moving violently. Sometimes they break by freezing. Quotes disappear, size shrinks, transactions move off screen. What looks like calm is often exhaustion. When participants stop trusting posted prices, those prices stop being meaningful. They exist, but they no longer clear supply and demand. In the silver market, that distinction matters more than ever. Futures prices can continue trading even when physical supply is constrained, but once the gap between paper price and physical availability widens far enough, arbitrage stops functioning. Normally, arbitrage is the mechanism that enforces honesty. If silver is cheaper in one place than another, traders buy where it's cheap and sell where it's expensive, equalizing prices. That only works if metal can move freely. When it can't, prices diverge without consequence. At that point, the futures market stops being a discovery mechanism and becomes a settlement mechanism. It's no longer answering the question, what is silver worth? It's answering the question, at what price can obligations be closed without delivery? Those are very different questions, and confusing them leads to bad decisions. This is where forced cash settlement becomes more than a technicality. It becomes precedent. Once contracts intended for delivery are routinely settled in cash under stress, participants internalize that delivery is conditional. That realization changes behavior permanently. Futures become tools for exposure, not ownership. Anyone who actually needs metal bypasses the exchange. Markets can survive that shift, but they don't emerge unchanged. Liquidity concentrates in fewer hands, transparency declines, volatility becomes episodic rather than continuous, and trust, once broken, is not easily rebuilt. The approaching government shutdown accelerates this transition by removing the final layer of confidence, oversight. When regulators go quiet, participants lose the assurance that disputes will be resolved quickly or fairly. That doesn't mean rules disappear, but it does mean enforcement becomes uncertain. In markets, uncertainty is often worse than bad news. Bad news can be priced, uncertainty cannot. This is why the idea that a data blackout will calm markets is misguided. Silence doesn't reassure participants, it forces them to imagine outcomes. And imagination, under asymmetric risk, tends to skew negative. No institution wants to discover after the fact that it relied on information that no longer existed. During blackouts, behavior compresses into shorter time frames. Decisions that might have been spread over weeks are pulled forward into days. Participants act early, not because they're panicking, but because waiting offers no advantage. That front-loading of action tightens conditions further, creating a self-reinforcing loop. Gold's proximity to $5,000 plays a critical psychological role here. That level isn't just symbolic. It's a threshold where gold's market value begins to rival large monetary aggregates. When that happens, gold stops being treated as a hedge and starts being treated as an anchor. Anchors are not traded casually. They are held, protected, and sometimes hoarded. For central banks and sovereign institutions, this creates a strong incentive to reduce lending and leasing. Why part with an asset that is gaining strategic importance? Why increase exposure to counterparty risk when the asset itself is stabilizing balance sheets? These are rational questions, and rational answers reduce available supply. Silver feels this effect indirectly but intensely. As gold becomes less available for lending, pressure shifts to silver. Industrial users, already constrained, compete with investors for diminishing supply. Unlike financial assets, industrial demand cannot be deferred indefinitely. Production lines need inputs. Substitution is limited. When supply tightens, price alone cannot solve the problem quickly. This is how structural stress manifests, not as a single dramatic event, but as a series of small frictions that accumulate. A delayed delivery here, a widened premium there, a dealer unwilling to commit to terms. Individually, these are manageable. Collectively, they signal a system operating beyond its design assumptions. One of the most dangerous moments in any market cycle is when participants mistake stability for health. Low volatility can coexist with extreme fragility. In fact, fragility often hides behind calm conditions. When everyone believes nothing is wrong, positioning becomes complacent. When the adjustment finally occurs, it's sharper because no one prepared. That's why watching non-price signals is essential. Lease rates, delivery notices, inventory availability. These are the pressure gauges of the system. They don't attract attention because they don't fit neatly into narratives, but they tell you what participants are actually doing, not what they're saying. As the shutdown approaches, the timeline matters less than the sequencing. First, uncertainty increases. Then, defensive behavior emerges. Then, liquidity thins. Finally, resolution is forced, either through delivery, settlement, or rule changes. By the time the process is visible to everyone, the key decisions have already been made. It's also important to separate inevitability from timing. Structural stress does not guarantee immediate failure. Systems can operate under strain longer than expected, but operating under strain is not the same as being stable. Each cycle under stress weakens resilience. Each workaround reduces credibility. The question then is not whether silver will move up or down tomorrow. It's whether the system that intermediates silver can still reconcile paper promises with physical reality without losing trust. Once that trust is questioned, it becomes a central variable in every decision. Markets don't collapse because of bad actors or conspiracies. They adjust because assumptions expire. For years, the assumption was that physical delivery would remain marginal. That assumption allowed leverage to build. Now, delivery is no longer marginal. It's becoming central, and the system was not designed for that. As visibility fades and oversight pauses, participants are left with one guide: behavior. Watch what institutions do, not what they say. Watch where metal flows, not where prices point. Watch which promises are honored without friction and which require explanation. In the end, this moment doesn't require prediction. It requires observation. The test underway is simple in concept and difficult in execution. Can paper claims be reconciled with physical limits under stress? If yes, confidence holds. If no, the adjustment will not be loud, but it will be decisive. Price will eventually follow, but it will lag the truth. Availability will lead. And once availability becomes the story, the market has already changed. The lights may go out on the data soon, but the signals won't disappear. They'll just move to places fewer people are trained to watch. And by the time clarity returns, the system will already have answered the only question that matters.